Thank you very much for having me. This is Nelly Algaz. I work for a company that is delivering risk advisory services for a huge amount of clients, and it's structured as is. So we have different hubs: energy hub, aviation hub, manufacturing hub, and then we provide practices. So advisory practices, cybersecurity practice, business resilience practice, enterprise risk management practice, ESG practice, specialized in each and every industry. So part of our specialization is to provide risk advisory strategy to those companies. I'm heading the cybersecurity and business resilience practices for Europe. And the idea here is, yes, to provide, from one side, what is our approach to cyber risk strategy, that we also include not only mitigation efforts, we are also including transferring efforts. And to do that, we use data and actuarial methodology. And I don't know if it rings a bell, but I will want to provide some bits and pieces. Actuarial methodology, it's a methodology that is based on basically a degree. So I will try to provide just an overview, and please reach me out if you are interested in having more information about that. So, first, I would like to present 3 topics. First is the relation between claims and the premiums that we are handling regarding cybersecurity. Later on, important, what do an insurance company that basically is the one who is going to pay with you the attack or the losses expects when they are assessing a cyber risk profile. Further, we will going to show how we can determine your cyber risk in terms of economics. And finally, we are going to see if your company needs or not an insurance coverage, at least how to determine that. So here we have on the left a graph that shows the relation between the cyber claims that we manage year by year, and so you can see it by the light blue line, and the increase in the premiums that one has after that claims. I think it's quite interesting that the premiums keep increasing year by year. By the extent of the increase, it's really tied to the cyber claims. And then we have here how the company, insurance broker, is using to analyze the risk profile, cyber risk profile of an organization. So it's pretty simple, actually. So it's the called mitigate, transfer, accept, risk curve. So if you can see here, all the risks that are high, that have high probability and low impact are the risks that we recommend, please mitigate it. All the risks that have high severity and low probability is the risk that after trying to mitigate, let's see if we can insure. One point here that I forget. Those are the claims that are complex. When I say complex, are the claims that have caused a loss up to 100,000 euros. Okay, there are not all the claims. So, looking back at 2019, the cyber exposure of massive clients, when we analyzed them, was like this. So one can see that there is not a cure. So that's why there were tons of successful cyber attacks. After 3-4 years, most of the clients, at least a decent number of clients, start to manage the cyber security risk properly and implement controls. So that's why we are starting to see a good curve that explains also the reduction.
Hello, sir.
In the premium. Okay. So, as a CISO, what do we think that you need to, at least to know your cyber risks in terms of economics? So, we saw, or we are used to do a classical approach toward cybersecurity, an audit, an assessment, an inventory management, an inventory classification, including pen testing, for example. But none of them, absolutely none of them, talks the same language as the CFO, that at the end of the day is the one who will provide you the budget. No one of them. That's why we think we need to start looking at our risk in economic terms. So this slide pretends to be simple. The idea is that we can include advanced risk quantification to know the potential cost of each risk and the overall cyber risk on the top of your regular risk assessment. And it goes like this. So once we set the control assessment, the control effectiveness, and set the probability, we will evaluate the impact. This is the classical approach. The short difference, I will say, is that we should include the expected loss for each and every side effect. What do we expect to a loss in business interruption for forensics, and classify that impact in terms of can be covered or can it be not covered. Then, to quantify, we have two options. Benchmark, so let's ask to our neighbors what happened there. Let's use a big bottom, such as big site tools, etc., that will provide us some orientation. Good luck if you need budget with that. Or let's simulate. And let's simulate using the same methodology that insurance companies are doing to ensure and to evaluate the cyber risk profile of their clients. Think about it. They are putting their money there. So, I mean, it's a methodology to consider. Yeah, so how it works. Those are the results, but prior I will tell you how we calculate it. So once we have the probability, we assign a distribution, a mathematical distribution, to the probability. The mathematical distribution that better explains rare and strange events. That is Poisson. It's always the same. And then we will assign the mathematical distribution that better explains the impact. It can be it can be a Gaussian, it can be whatever. So this changes according to the risk that you have. But we also will include our claims data, our proprietary data here. So if without the proprietary data, the methodology is similar to FAIR. I don't know if you heard about it. Providing data, we enrich the methodology. And actually is what insurance companies are doing, and we are providing for our clients. Then we will start the simulation. So what is about? We are going to simulate what can happen the next year 10,000 times. So the idea here is to see how the risks are moving, how the risks are appearing. So we start first year, nothing happens. Second year, nothing happens. 10th year, something happens. Okay, let's start with the distribution of the impact. Simulation, and it throws, I don't know, a loss of 200,000 euros. Okay, noted. And we keep with that methodology during 10,000 times. Then we include a stress test. The stress test means to demonstrate the robustness of the system. So if we saw that the numbers are not robust, we start to simulate again. We simulated even more than 50,000 times. And with that, we order all the results from the least to the greatest. And we will have a lot of results, nearly 50%, that it's just zero. Okay, those are dropped. And then we will have the rest of results that includes some loss, from the least to the greatest. And then we will include that so-called return period. The return period is assigned to a frequency. So we use, in that case, the regulation Solvency II that tells us that we should focus on the return period on 1 between 200. That means 99.5%. It means, again, that if something happens, with a 99% of probability, will fall below that number. This is the first number on the square. In that case, 140 millions is the value at risk on 1 between 200 simulations. So that's the risk that we have at the company. This is the global risk. We have different types of risk, so we should calculate, we are able to calculate the risk global, the risk that is subject to transfer, and the risk that is subject to mitigate. On the other hand, we have the tail value at risk. So what happened with the rest of 0.005%? So it's the average of the rest. And also, we are able to apply the same methodology for each kind of risk scenario. That's why, once we set the strategy, and once we set the mitigation strategy, we will launch the simulation again with that design and see how the risk drops. This methodology, that is actuarial methodology, that is tied to economics, is completely understandable by the CFO. And the idea behind this is to provide an additional tool backed by a big industry to defend your cyber strategy. Okay. Then we have how to analyze if we need or not need an insurance coverage. So here are the steps. I'm going to go directly to the results. So for example, we have a ransomware gap analysis. In that case, one small part of the losses, and we simply compare it with the current available insurance policies. And one can see that there is, in that case, a good coverage for two largest exposures, but only if data is corrupt. Data is not corrupt, is not covered. So here we have that maybe we should think in transfer as part of the potential loss to the insurance company. Up to what limit? Up to the limit that we calculated before. And we are going to do the same for each and every scenario. And we will obtain this. And we will say, okay, we have some coverage with your current classical program, but we should think if we need coverage or not. Maybe we want to just mitigate all. It's up to you. But we should think and consider if we need coverage from that part. And that's all from my side.